What is going on, option traders? Hopefully soon to be option traders. My name is Bo Crable, the founder of Option Scout, and in today's video, I'm going to cover over everything you need to know about dividends in regards to options trading. And there's going to be 3 core lessons I'm going to be teaching you in this video. And the first thing is about how the overall risk of getting assigned on your option contracts or getting exercised is just much higher during or when there's a stock that has dividends, and also during the time where a dividend may be coming soon. And the second lesson I'm going to be teaching you is about how to avoid getting assigned, since the risk is much higher. And then the last thing I'm going to cover, which is very interesting, is about how some traders may actually have to end up owing the dividend, depending off of what contracts you're selling or buying, or what strategies you're utilizing. So that could be really, really annoying. So to get right into this video, before I get into the concepts, I need you to know these 2 things. One is about the ex-dividend date. To make this just really simple for you, the ex-dividend date practically means that if you buy the stock on the ex-dividend date or after, you don't get the dividend. And if you own the stock 1 second before the ex-dividend date, then you get it. And what 1 second really means is like the last trading day before it. So example, you could buy the stock 1 day before the ex-dividend date, and then you could sell it on the ex-dividend date and you get the dividend as well. So the next thing I want to teach you about is how options, if you buy them or sell them, whatever, they don't entitle you, that you don't get a dividend. Like, options do not get you. Even if you're buying leaps that are really far to the money, you do not get the dividend. Okay, only shareholders do. So now you might be asking, okay, Bo, then why are we even talking about dividends? Because what an option contract is, it is a contract for 100 shares. And most importantly, this is really important for like people who are selling naked options or doing even covered calls, is if you buy one call contract, you're entering into an agreement or contract, whatever, to possibly exercise 100 shares of stock. And if you're just shorting or selling or writing those contracts, you're actually entering into agreement to short 100 shares of the stock. And that's going to be important for the third lesson. Okay, so let's get right into it. Risk assignment, why is it higher? Well, the reason why it's higher is because this core concept called extrinsic value, or also referred to as time value. So if you see online people talking about time value or intrinsic value, it's the same thing. It's like potato, or eggplant and aubergine. It's the same thing, okay? So let's talk about this. With an option price, it's made up of 2 things. An intrinsic value, so with an I, and extrinsic value with an E. Intrinsic value, a good way to explain this to you is, let's say you bought an in-the-money call option. And let's say the stock is trading at 100 and the call option that you bought is at 90. So right there's $10 of intrinsic value, because it's, you can think, remember this way, in is in the money. So how much in the money is it? Okay, and extrinsic is not about how far out of the money is, it's just the other component to it. Because if a call contract is at 90 strike and the stock is at 100, it's going to be at least $10 the option price, but it's going to be much more than that, or not. It couldn't be a lot more, but they'll have an extra extrinsic value to it. Puts, it's the reverse. So if a stock is trading at 100 and a put is at 110, the extrinsic or the intrinsic value is going to be 10. Okay, so the final part is the extrinsic value, all right? And that's going to be made up of like the time. So if there's more time, it's going to be more intrinsic value. The implied volatility, so how volatile the stock is going to make up the intrinsic value. So there's that. All right, so now let's kind of segue into how to avoid getting assigned. And the reason why I'm talking about time value and intrinsic value is because this is all what it's about. Let me give you an example. Let's say we have trader Sally. And Sally owns 1,000 shares of her favorite stock, but maybe she's a little, not exactly bearish onto it right now, but she wants to collect income. And the stock has a dividend as well. So she's like, you know what? I want to make money through capital gains. I want to get, covered call income. I want to get the dividends. I want to get it all. So she owns 1,000 shares, and let's say it's January, all right? And she sells a 10 call contract. So this would make 10 covered calls for 2 months out. So in, let's say, end of February or beginning of March, they're going to expire. And let's say everything's going fine, then boom, the stock shoots up. So the stock was at 100, and then just all of a sudden it shot up to 110. And let's say the call contracts that she sold were at 108. So the strike price she chose 108. The stock is now at 110. That means the call contracts are $2 in the money. And let's say, to make matters worse, because she already knows, okay, I might have to sell, but let's say the call contracts don't expire for another like 10 days or so, but let's say tomorrow's the ex-dividend date. What's most likely going to happen is that the extrinsic value of the call options are going to be less than the dividends that's going to get paid out. Because again, if you own the stock a day before the ex-dividend, you get the dividend. So think it as somebody who bought those call contracts. If the time value, the extrinsic value, is less than the dividends, of course you're going to exercise that because you're in the money, so you have $2 of intrinsic value, and the dividend is worth more than the extrinsic value, so boom, you're going to exercise that all day long. And now Sally wakes up, it's the ex-dividend date, she gets notified, hey, you got exercised, sorry, you don't get the dividend, oh, also you don't own your stocks anymore, yeah, sorry about that, you held your stock for the last 3 months, again, no dividend. So now that we understand how that's going to work, let's talk about how to avoid it. So the best way to understand how to avoid it is, why would somebody do it? So I just explained about how that's extrinsic value. So, okay, all what this is going to come down to is you're going to get assigned if the time value, extrinsic value, is less than the dividend. That's really it. So you won't, like, you're not going to, it depends on what's going on. So if the expiration date is really, really far away, you're probably not going to get assigned. So if you are, let's say the dividend is in, I don't know, or actually no, let's say the expiration's in 3 months from now and the ex-dividend date is tomorrow and you sell some call contracts, like you're probably not going to get assigned. But if you're looking at like 2-3 weeks from now, I would get very, very cautious a month before. So one simple way to avoid it is just like don't sell call contracts that are during ex-dividend date. But another thing, what you could do two things. You could buy back the call contract and just take some losses, but you need to do that before the trader would assign your call contracts. So, and again, this is a little bit iffy. Like you could use some tools and stuff like that, which at Option Scout we're working on it, where you could see that extrinsic value is like, okay, shoot, the extrinsic value is getting lower and lower and lower. I need to buy back the call contract, so you could pay attention to that. Or something else that you could do, which is probably just a better way to do it for a lot of things. One, you're not gonna have to stress about this. And two, it's just kind of like pushing the can down the road, is about rolling the contracts. So a strategy, what you could do is, again, let's say for Sally in the situation, if she saw this happening, or if she was aware that the ex-dividend date was going on, and let's say she found out about it later, she was like, what she probably should have done is then roll the contracts and just push them out for another date. So this isn't free money. A lot of people associate this with being free money, but it's not. So instead of her contracts expiring in 10 days, maybe she just pushes it out to, I don't know, a couple months from now. So that's another thing she could do. Okay, so that's kind of the main thing. So again, to recap that, to avoid it is just don't sell contracts during that time. Also, you could buy it back. You're going to be at a loss there, but that's okay. But if the stock went up that much, you probably would be happy as well. And then you get to own the stock, and you also get the dividend as long as you do it before the ex-dividend date. Or the last thing, just roll it. That's my personal favorite thing, just roll it, okay? So you're not going to mess up with that. Okay, so the last thing I want to talk about is how traders, some of them, can actually end up owing the dividend. So the best way to think of this is, let's just do the reverse example of what I did with Sally. So Sally did cover calls, but let's just take the same example, but changing it from a covered call to a naked call. Now let's think about this. So what Sally's doing, she is entering into an options contract where she is at the risk of getting assigned for 1,000 short shares. So let's think about this, all right? If the stock starts to shoot up to the moon and she gets assigned, she is going to end up owing the dividend, because when you're shorting a stock, the stock goes down when the ex-dividend date, when the dividend is involved. Okay, so if the dividend is 50 cents, and on the ex-dividend date, the stock will go down 50 cents. So for short sellers, it's not free lunch, it's not free money. So, however, if you're shorting, you have to end up paying that. So now you may be wondering, okay, Bo, well, I don't do bearish strategies, so I don't have to worry about that. Yes, you do, because if you do like long call spreads where you have a long call and a short call, you're going to need to think about that. Or let's say, again, a short put spread or a long put spread or an iron condor or any type of strategy where you are having some type of contract you sell, you really need to understand this. So let's take a long call spread, for example. At any moment to avoid it, you could exercise your long call. Like you could do that for sure. But let's say a really bad example, you exercise your long call, but you do it on the ex-dividend date, okay? And the short call got assigned a day before the ex-dividend date. What's now going to happen is, you're going to owe the dividend, and also there's kind of not really much reason at all for exercising your long call. Maybe you should just sold it or something like that. So yeah, that's pretty much the entire situation. For the puts, it's the reverse. So long story short, just to recap this entire video, you need to be very aware of this stuff. I would recommend do your homework whenever you're trading options on what stocks you're doing it, and also on ETFs, because some people forget that ETFs like the S&P 500 and things like that, or even QQQ, do pay a dividend. So if you're trading options on that, be aware. If you're trading on stocks that have no dividend, you don't really need to worry about this. But this is, and also if you do a European style options, you don't necessarily need to worry about this too much as well, because you can't, like, it's only American style where you can trade, in between all that stuff. But yeah, so if you are doing that, be aware of the extrinsic value, and you need to be aware of that as well if you're trading any type of strategy that involves writing or any type of spread, because even though you're not doing a bearish strategy, you still can be at risk of having to owe that, because people just play around with it and everything. So I hope this is clear, and if you like this video, give it a like, make sure to subscribe, and also check out the links down below if you want to see any of our cool software for options trading.